Maithili Bushramath is standing by New Delhi, and now joining in on the show is Arvind Sethi, MD and CEO at Tata Asset Management. Thanks very much for being with us, Mr. Sethi. Now, to start off with, the growth is going to be far less sensitive to the election outcome than the stock markets. But assuming that we do have political stability, lending rate cuts, as well as a normal monsoon, what's the best case scenario that you're working with for GDP?
I think the best case for next year would be somewhere in the 5.5–6% range. And you made a very big assumption there about interest rate cuts, but maybe we can talk about that as we go along.
Mr. Sethi, what kind of outcome are you expecting from the FOMC meet? Do you expect the FOMC to continue with that 10 billion, or do you expect them to call a temporary pause?
No, in the US there is still no sign of inflation, and we expect that rates will continue to be low for a while, and the FOMC will continue reducing its buying, which means it's still buying, but it's buying less. And the market, at least the yield curve, suggests that the first rate hikes are going to be around the third quarter of 2015. So we'll go along with that consensus in the market. Because inflation is still 1.1% and there really is no sign of inflation. So the Fed, I don't think, is unduly worried about the rates being too low.
Okay, but we had Janet Yellen telling us that it will be 6 months after the end of tapering, whereas you say third quarter of 2015. What makes you take a slightly different position from what has been accepted wisdom? I'm not saying they're right, because we're all reading the tea leaves and perhaps getting it very wrong most of the time. But your number seems to be a bit of an outlier. So I was wondering whether you could tell us why you arrived at that figure.
No, if you look at what the yield curve and the forward rates in the yield curve are suggesting, it's in the sort of latter half of 2015 that they expect rates to start being raised. But by that I mean the Fed funds rate being raised. So that's what the forward market is suggesting on the yield curve. So, and that's what we're going along with. And as I said, we don't see any inflationary pressure. So there isn't that urgency for the Fed to raise rates right now.
Oh, absolutely. I think this has been one of the most remarkable things, that despite the monstrous amount of money that the US Fed has pumped in, inflation rates are so low in the US. I wish we could get some of that. But how do you look at bond yields in India? Do you expect yields to go up substantially? Depending on, of course, a lot will depend on what the budget numbers reveal. But what is your best guess for what bond yields will be like, say, maybe by June this year?
Maithili, I think June is too short a time, and I think from what we understand what Dr. Raghuram Rajan is trying to do, he's an inflation targeter, and I think he's made it very clear that what he's trying to protect is the value of the currency in terms of its purchasing power. And therefore, what we think is that if economic growth was not as weak as it is, we would have thought rates would have gone even higher. But given that there is such a weak growth, we think rates will remain high, and therefore the 10-year bond yield would probably creep up to something like 9.25%, maybe 9.5%. But if we look further down the road, and let's say not 6 months, but a year to 2 years down the road, we think interest rates are going to be much, much lower. And we think that the commitments or rather the sort of proposals of the Urjit Committee report about bringing inflation down to 8% by Jan 2015 and 6% by 2016, I think they will be able to do that, which means that the bond yield from 9% could be somewhere in the 7% range. But it could be a couple of years down the road, but we don't expect interest rates to come down in a hurry locally.
Okay, so you certainly don't expect him to take the IMF advice, because the IMF, in its recent Asia-Pacific outlook, has argued that India needs to raise its interest rates a little bit higher because inflation still seems to be high and persisting. But you don't think the central bank governor will take that advice too seriously. Mind you, he was from the IMF earlier.
You see, that's what I said. If it wasn't for the weak growth, he would have raised the rate. And we think that, well, maybe there's another 0.25% left. But given that inflation is beginning to taper off, given that, the impact of the rupee depreciation last year will then slowly begin to sort of show that the inflation number is coming down, I think they'll just be very, very careful to raise rates. So, as I said, the bias is certainly rates are not coming down. They could perhaps go up a bit. But the 10-year bond yield could still react independent of what happens on the rate side. if inflation ticks up, then the 10-year bond yield could move up even if the short-term repo rate isn't moved up.
Arvind, today, apart from the FOMC meet announcement, there's going to be one more important announcement that we're waiting for. That is the USTR, the Trade Representative Report on the Special 301, which could possibly impose trade sanctions on India. Possibly, I say, because that seems to be a little bit of an extreme scenario. But what do you think would happen to our current account deficit if, God forbid, the US were to impose those kind of sanctions?
Well, I really don't have a very strong view on whether they will impose it or not. And as you say, it's a small chance. But it would clearly be very negative, because one of the things which is keeping us going is the buoyancy of the developed markets, particularly the US, and that we can see in the export numbers. So while the local economy is weak, I think there is strength overseas. And if the trade sanctions were to come in, it would be very damaging for us, something we could ill afford.
Okay. Mr. Sethi, I just want to draw a leaf from what you said earlier. I somehow come back to questions on bond yields. Did I hear you say that you believe that yields could go up to 9.5? And I would presume that by that, you're meaning the liquid bond. The slightly illiquid ones, in that case, would probably shoot up to 9.8, 9.9. Is that your belief?
No, what my view is that I think there's a possibility that rates could shoot. Right now the 10-year bond is under 9%. It's at about 8.9. I think somewhere around 9.25 is where it could touch, perhaps 9.5 in a bit of a panic. But as I said, I think they'll probably stay at around 9% or around these levels for a while. They're not going to come down in a hurry. And but as I say, if we were to look 2 years down the road, we see them much, much lower. We don't, but how high they can go in the short term, probably a little higher, as I said, but I don't have a very specific number other than just some guiding numbers like 9.25, 9.5.
And Maithili, before we let you go, run us through the trajectory that you're looking at for the currency. Do you think it's more driven by the movement of the US dollar rather than political regimes in New Delhi?
Well, actually, in the complex world of real-world economics, it's driven by so many factors. It's very difficult to pinpoint any one factor. Yes, certainly what happens in the US will impact us because we are far more globalized than before. So things like capital inflows will affect us. At the same time, political uncertainty, the kind of government we get, the kind of policies we announce, all that matters. And then, of course, we have the Reserve Bank of India. We already have the report saying that, they worked out a new RER based on the consumer price index, which seems to suggest that the present value of about 60 rupees is roughly where the RBI thinks it's reasonably priced. So if the Reserve Bank has any clout, and I think they still do have some armory with them, I think it will remain in the area of 60, 61 for a while to come. Unless, as I said, there are very nasty surprises ahead for us. And I do hope very sincerely that there are no such surprises.